Hello, everyone. Today on the final bar, we will wrap the week. We'll focus on how the markets have evolved from last Friday to this Friday. We have a lot to talk about, friends. We have further distribution today, really accelerating in the afternoon. Bit of a sell off in the early part of the day, similar to yesterday, but continuing to push further and further to the downside. The tech heavy NASDAQ leading the way lower. Energy, bright green at the top of the list, making a new 4-year high. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we use the power of stock charts, the power of the technical analysis toolkit to better quantify investor behavior, better understand what is happening in these uncertain times. They truly are uncertain times, right? We think about elevated volatility, the VIX, well above 20, nearing 30 once again. Elevated volatility, elevated VIX means elevated uncertainty, and that's certainly how I would describe this market environment. A lot of speculation about what is coming through the course of this year, what the Fed will do, and when it will happen, the pace at which they will start to raise rates, and what sort of impact that's going to have. The market over the last couple of sessions really showing you, I would argue, how much of this is not yet priced in. And I was interviewed earlier today and asked about aren't these big cuts already priced in? Aren't we aware of it? And I would say the idea that cuts are coming down the road versus the reality of what higher interest rates actually mean for consumers, for things like getting loans and buying cars, buying houses, and all of that, and the headwinds to growth stocks. We're really seeing that play out. Makes me feel like there may be much more to come. We have great guests on the final bar to help us try to navigate things. This week, we had a lot of great conversations. Ryan Dietrich from LPL yesterday, Carolyn Borodin on the first time on the show Wednesday of this week. Next week, some more great guests for you. On Tuesday, the 15th, we have Jay Soloff from Investors Alley. On Wednesday, the 16th, Sean McLaughlin from All Star Charts. He's their chief options strategist. I will be out Thursday and Friday of next week, so we have some great special content lined up for you. On Thursday, the 17th, Julius DeKempener from RRG Research has agreed to guest host this show, so we'll be sharing you some thoughts on asset and sector rotation. Also, our latest episode of The Pitch is coming up on February 25th. My friend Grayson Rose here at Stock Charts is going to be moderating a conversation with Tony Zhang from Options Play, John Kosar from Asbury Research, Mark Newton from Fundstrat. You can go to stockcharts.com/thepitch for more information on that event coming up on February 25th. Let's continue on our show here with our Wrap the Week segment. This is really the core of our Friday show, two pieces. We wrap the week looking at some longer-term trends and how they've evolved over the last 5 days, and our mailbag, which we'll get to in a little bit. But first, I want to share with you the results of a poll. We always have a poll going on our Stock Charts TV live stream page on our website, also through social media. And we asked you recently, in your opinion, what's the probability of the S&P 500 closing above 5,000 on June 30th, 2022? So you've got a bit of a runway there. That's 4.5 months away. What's the chance that we close above 5,000? The majority answer, 55%, said below 30%. 24% of you said 30 to 50%. And, the rest evenly split between above 50%. So to reinterpret the results of that, 79%, almost 4 out of 5 of the respondents said it's a less than 50% chance that we close above 5,000. I'd be interested to know how that poll has changed. If we would ask you a week ago versus the last couple of days, we're asking this in the midst of certainly a growth-led sell-off, with a lot of the growthy stuff really leading the way downwards, tech and consumer pushing to the downside today and dragging pretty much everything or most things down with it. So I'm not surprised to get that sort of result. I would probably say 30% as well. I might say 30 to 50%. I think there's certainly a probability, and I would say this poll question for me, makes me think of some of the conversations I've had about probabilistic outcomes, right? We don't know what's going to happen. No one knows what's going to happen in the next minute. Forget about the next week or the next month or the next year. It's all guessing, educated guessing, and based on market history and trends and all of that. That's totally fair, but it's still a guess. But at the end of the day, you have to think about the market in terms of probabilities. There's a chance the S&P rips above 5,000 in the next 6 weeks. There's a chance it goes and touches 2,500 in the next 6 weeks. I don't think either of those scenarios are very likely, but they're possible. And I think thinking of the market in terms of probabilities and what probabilities would mean for your portfolio is a really good way to think about things. Continuing as we wrap the week here, let's just look at today's trading briefly, and then we'll get to some of the longer term charts that I think make sense. Things. There are a couple key takeaways for today's session. S&P down almost 2%, with the S&P closing just below 4420. The NASDAQ leading the way lower, with the NASDAQ 100, the largest, most promising, stable companies in the NASDAQ are down over 3%, with the NASDAQ 100 around 14,250. Now, this uncertainty, this elevated fear that is manifesting itself in lower stock prices is pushing volatility higher, and the VIX is just above 28. Now, again, volatility it tells you not necessarily fear. Arguably, it's more uncertainty. It's volatility. It's relative movement, and based on options on the S&P 500. And if you look at the VIX, you can see it spent pretty much the most of 2022 above 20, and I think that will most likely continue to be the case. Interest rates came off because there was certainly a flight to quality in the form of Treasury bonds today, with the TLT up 1.5%. 10-year yield had been up around 206 earlier today, finished today around 195 or so. So this is coming back below 2%. Certainly fairly elevated relative to where we've been in the dollar index, pushing higher today. Gold finally coming and stepping up to the plate as a safe haven. We often talk about, stocks selling off. Why aren't people going to gold? You're actually seeing that play out today. The GLD is up almost 2%. Same with silver. Oil prices up significantly as well. And if you want to find the outliers, look at today at the big green at the top of the list, with energy up while pretty much everything else was down. Cryptocurrencies also participating in this risk-off scenario. A lot of red on the top 10 coins that we follow. Bitcoin down 2.4%. Ethereum down 5%, back below 3,000. Just here in the last couple hours, really starting to break down through some key support. That 3,000 level is a really important one, I would argue, to watch for Ether. Now, it's interesting on the sector basis. I would just worth noting, this is a value over growth day. Growth seriously struggling, and if you look, technology, consumer discretionary, communication services, all down 2 to 3%. If that happens, it is impossible for the S&P to be anything but fairly negative, because those are the largest, most significant weighted sectors in the S&P. Those three sectors are down significantly. The entire market's going to be dragged down with them. It's interesting, as I look down in the predefined alerts section, I see a ton of red with different bearish readings popping up. And then right at the top of the list here at the end of the day is energy setting a new 4-year high. Talk about energy and everything else. Today is that in a just a little encapsulated form of what's been happening here year to date. Energy up almost 3%. The XLE now up above 20, almost 25% year to date, while most sectors are flat to down. And so what also was not too far in the negative, utilities actually finished around unchanged for the day, and consumer staples only down about 1/3%. We're going to look a little later at that ratio between consumer discretionary and consumer staples. Days like this firmly reinforcing the allocation to defense over offense. Let's look at our wrap the week chart. I got to refresh this just because there's a lot of movement going into the close. Here's the S&P 500 in black, down almost 1.9% for this week. This was not a great week. Now, a lot of that deterioration came obviously in the last two trading sessions. On Wednesday, we were up about 2% for the week. All of a sudden, we gave all of that up and double to the downside. So we're down almost 2% for the week. Only one thing underperformed the S&P, and that's not surprisingly the NASDAQ 100 down 3.1%. Everything else outperformed large cap stocks. In red, we have the TLT, the long bond ETF. In orange, we have emerging markets up 0.1%. In green, the US dollar, the UUP, up 0.7%. Here we have crude oil prices up 1.3%. In purple, we have small caps, the Russell 2000 ETF, up 1.4%. The biggest winner of the week, gold up 2.9%. And again, I'd reinforce, it's overly simplistic and often incorrect recently to think of gold as a safe haven and expect a contrary relationship between stocks and gold. They've actually moved together a lot of times here. This was one day where you're seeing a flight away from risk assets and into two things today: gold and bonds and fixed income instruments. And those are the two things seeing the biggest gain, and they are two of the top three performers so far this week. We'll add Bitcoin in the mix just to show where that's at. Gold narrowly beat out Bitcoin in terms of the week to date, or the 5-day performance. Bitcoin ended up 2.3%. Now, a lot of that was given back here just recently, but earlier in the week, it was the big winner, up 6 to 7%. Let's continue on the Wrap the Week segment, looking at the Mindful Investor Live chart list. This is a chart list that I keep maintained on Stock Charts at all times. To access this list from your own login, you can go to the Articles tab, go to my page, which is called the Mindful Investor, and you get to this chart. I just posted a video earlier today, an article, on my blog, The Mindful Investor, talking about RSI and the idea of looking at RSI on different ranges and how important that is. This is work that I first read about from Connie Brown years ago, and others have tried to, sort of put more detail behind that idea of adjusting the whole range. But we look at that improvement on Wells Wilder's original RSI, and we look at Disney and the S&P 500. I would strongly encourage you to check out that article, because there's a lot of good takeaways, I think, in terms of the environment we're in right now. My market trend model is based on weekly data and exponential averages of that weekly data. Looked potentially like there could be some change in the signal, but given the weakness that we've seen in the last 2 days, Thursday and Friday, pretty much remaining as it has been. Short-term model remains negative, turned negative about 4 weeks ago. The medium-term model turned negative 3 weeks ago and remains bearish here as well. So short-term bearish, medium-term bearish. The long-term model for me remains positive and sloping downwards, getting closer and closer to a sell signal, but not there yet. Long-term model is really meant to capture more of the really negative moves, ideally more of the secular rotations away from stocks. We're not seeing that quite yet. The medium-term model for me is the main risk on versus risk off. So in my own accounts, anywhere where I do have levers that I pull between being more or less risky, I am incredibly in cash and or short any way I can do it. At this point, given that weakness in that model, it's basically telling me to think much more about downside protection, much more about risk management, and less about upside opportunity. And it's telling me to stay in that thought process here. Now, when you look at the S&P 500 on a daily basis, I asked pretty much every one of my guests this week, if I remember right, what they would need to see to sort of change their opinion, or what their main takeaways are. And one of the things that I took away from this week, just watching the markets very, very closely, particularly this chart of the S&P 500, is what I've called this range within a range. We talked even on yesterday's show and on Wednesday's show, settling into this range between the two Fibonacci levels. We take the January high around 48.10, the January low around 42.20. You take the Fibonacci retracements between those two extremes. We have 44.50. And we have 45.90, essentially, just below 4,600. Now, both of these levels have been tested and confirmed in the last week and a half. We've bumped up to that first, the 61.8% level a couple times. We've bumped down into the 38.2% level as well. As of today, given the weakness that we saw going into the close after yesterday's sell-off and following through to the downside, the S&P is now closed below its 200-day moving average. Last time that happened was back in mid-January. And after that, we only had one more day of undercutting and putting in a much lower low. But after that, we chopped around for about a week before bouncing back into where we've been here recently. I would see today as the downside follow through, which tells me to expect more downside before all is said and done. This tells me that the markets can and most likely will correct in terms of price and or time. And the fact that we've gotten below those levels is key. As long as we remain below the 200-day, remain below 44.50, which is that level indicated right there on the chart, I think this is a fairly bearish tape with downside potential. And also the article that I mentioned, what we talk about is the fact that the momentum has been steadily declining. So overall, you're getting the market attempting to rally like we have in recent weeks, but the momentum is getting less and lesser. And that is a sign of less buying power, not more buying power. It's a sign of weak bullishness and not overwhelming bullishness. It tells me to still think more on the side of caution here. Now, a lot of our breadth data is updated after the close as we're digesting all of the closing bell data and updating our databases and all of that. So some of this breadth data isn't quite updated for today. I will tell you, given the deterioration that we've seen, most likely most of these breadth readings will be going down in some cases quite a bit more than what they are today. But this is as of Thursday's close. These are the cumulative advanced decline lines. We've talked about the fact that we've had this breadth divergence where a number of the cumulative advanced decline lines actually made lower highs in January, while the S&P and the S&P's breadth line made higher highs. Now we're starting to see all four of them back below their 50-day moving averages. We've seen the small cap breadth line, go below its low from December, and now most likely continue to push lower. The NYSE advanced decline line most likely will follow through there either today or into early next week, and that tells me to be looking for confirmation from mid caps and from large caps. So looking to see if they break some of these previous lows and indicate a follow through of breadth to the downside. Only about 43% of the S&P members are above their 50-day moving average. Only 53% are above their 200-day moving average. So just like the S&P is failing to hold its 200-day moving average as of today's close, finding a lot of individual stocks that are struggling with that as well. These lines going lower, particularly the one at the bottom, the percent above their 50-day remaining below 50%, fairly negative sign for stocks and certainly a pattern to be looking at going into next week. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. Thanks so much for joining us every weekday after the close for our show. A couple quick announcements before we open the mailbag. First off, we love to get your questions. All the questions you're going to hear are from viewers like you over the last day or two. We would love to hear from you. Hope to answer one of your questions live on the air Tuesday of next week, which will be our next mailbag segment. You can get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer one of yours on the air on Tuesday's show of next week. Also, go to stockchartstv.com. That's our on-demand platform. It is completely free. You just need an email address, and you can start watching all of our great content. Guest appearances like we had this week. I mentioned Ryan Dietrich, Carolyn Barod, and so many more really knowledgeable analysts and traders. Special events like The Pitch and our Market Outlook specials from January and so much more. Go to stockchartstv.com, or on your mobile device, just search on the App Store for Stock Charts TV on demand. We now move on to the Final Bar mailbag. Keep your questions coming into us, and we'll get to the first question now. What RSI levels do bear market rallies typically top out at? Is there some sort of RSI range that could be used for an overbought signal on a bear market rally? And I'm giggling because I literally just wrote an article on this earlier today. I'll show it to you. So if you go to the members page, and the answer is, of course, there certainly is. Go here to the Mindful Investor, which is my homepage. You see this top article, the indicator to watch for Disney and S&P, the S&P 500. We'll look at the range, and essentially what we talk about is the fact that the entire range of the RSI will bump up. And in a bull market phase, the RSI doesn't tend to go much below 40. Those are the buyable dips. When that changes, when we start becoming oversold when we sell off, when we don't get above 60 on a rally, that tells you that the bear market phase is more happening. So a bear market rally usually comes out of an oversold condition, usually sees the RSI top out at or below around 60. And that is usually the confirmation that we remain in a bearish range and the market's turning lower. What concerns me on charts like Disney and the S&P and others is we are getting rallies, we're getting bounces off of new lows, but the RSI is remaining in that bearish territory below 60. So I would check out that article, and there's a link at the bottom of the article to my YouTube video I recorded earlier this week on that same topic. Should help answer your question pretty thoroughly. Next question. Here we go. I recently watched a video interview of Sam Weinstein talking about his stage analysis methodology for stock picking. He referred to using it in the 70s and 80s and how different things are today. I'm wondering if you still see this as a valid, worthwhile system. Yeah, so Sam Weinstein, I should know the title of his book off the top of my head. I remember it has his picture on the left, and he taught, I forget what the name of it is, but it is a fantastic read. And I'd encourage you to check it out if you haven't. Just a really thoughtful analyst and money managers I used to work with and for. Followed Stan's work for decades and just continued to appreciate his ability to define what trend different markets are at. That stage analysis that he talks about is basically, if I remember, and I'm paraphrasing because it's been a year or many since I read his book, but essentially talks about like 4 stages, right? There's a bottoming stage, like a bottom stage, like a bull stage, a top stage, and then a bear stage. And the labels are probably different. That's pretty much what it is. It's like we're bottoming, we're rallying, we're topping, and we're selling off. And when we talk on the show about an accumulation phase and a distribution phase, I would say those probably line up beautifully with how Weinstein would describe the up phase and the down phase, right? Sort of those bullish and bearish phases. We're looking at the same things, how things transition from a rally mode to sort of a consolidation phase. I sort of group all of those things as consolidation, which is sort of like an equilibrium when we move sideways. So I guess I have kind of a three-phase way of thinking of things, but it's very similar. And I think that approach of thinking about what phase a stock is in and recognizing that, I think makes a ton of sense. So while the markets have changed, they've certainly evolved. Absolutely, maybe the time frames of some of those stages may have evolved. I would argue it's still a very good way of thinking about stocks and grouping them based on similar patterns, which is probably what it can be most helpful for. Next question. Hi, Dave. Do you short the market? If so, what instrument do you use? So I will tell you, I very rarely do, and I tell you why. I've spent it's probably too much time with long-only money managers that were pretty much against the idea of shorting. And to be honest with you, if you short anything as a long-term play, you have to remember you are fighting centuries of the equity market's ability to generate wealth. So on shorter term opportunities, I think it can make sense for particular names where you have an edge and you feel like there's something that's way overpriced relative to the reality. I get the idea, but just remember, in terms of broadly shorting the market, chances are you're going to be wrong because the market's in a bullish trend way more often than it's in a bearish trend, and you're limited in your downside. Something can go to zero, can't go any more than that usually when you're thinking about equities, but there's unlimited upside, and so the odds are against you over the long term. Now, having said that, full disclosure, I currently in my own personal accounts own SDS, which is a double short S&P, the QID, which is a double short NASDAQ. And I did that earlier this week, given the rotations that we've talked about, given the fact that I think the conditions are changing. I don't think people are pricing. I don't think the market's pricing in the reality of rate hikes and what that's going to mean, and the reality that higher inflation is presenting. I think the last couple of days we've seen a lot of the things that have been emerging for quite some time. I think these are narratives that are going to impact investors for a while. Those are not long-term positions. I probably won't keep them on very long because I don't. The long-term bet is pretty tough. So what instruments would I suggest if you're not familiar with it? The simple ones: the short S&P, the SH, short NASDAQ, the PSQ. Those are like simple, just inverse ETFs. The double ones that I mentioned, SDS and QID, I think are good on a limited basis. But just remember, the moment you hold any of those, particularly the leverage ones, over one trading session, you're really going to start disconnecting from the returns of the S&P. Remember, if the S&P is up 5% for a month, it doesn't mean that the double short S&P is going to be down 10%. It's not a perfect thing. It's doing the daily percent return. So depending on how the individual days are, your returns could look dramatically different than you want. They're really intended to be short-term instruments, and that's it. Next question. It was a year ago when I asked about SPCE, Virgin Galactic. I was able to sell it about $56, and now that it's down about $9. Let me bring up the chart here because I don't have that chart in my head here. Okay. I was able to sell it at about 56, and now that it is down around $9. So great job selling it. Essentially, what ended up being one of the peaks was a huge double top pattern with Virgin Galactic, and from there has really started to come down. I'm thinking about getting in. What do you think? So of course, I'll give the standard disclaimer. I'm not recommending anything, and I encourage you to make your own decision based on best practices and your work with a financial professional. Having said that, what are the charts telling us? So I have trouble buying a chart like this. I have trouble thinking that something like this is a good idea, and I will tell you why. It's the same with Facebook when it drops, Netflix when it gaps lower. When prices go down from 50 something to single digits, it went down for a reason. And I get the idea of it's trading so low. So how much lower can it go? The problem is if you buy now and it goes down $1, you're taking a 12 to 13, 15-ish percent haircut on the stock, maybe a little bit more as I'm trying to do quick math in my head and talk at the same time, but it's a big number. And so the problem is just because something has gone down a lot, I have found is rarely a good reason to own anything. Which is why, for me, looking for signs of accumulation, that's what I would look for. Talk about Sam Weinstein's stages. I mean, you're in a distribution phase or a down phase. And now we've arguably consolidated, right? We're settling into a range, but I don't see anything on this chart telling me that a bottom is in that I could say with any sort of confidence. Putting in a higher low, that would be encouraging. We haven't really done that yet. Making a new swing high, getting above $10, which is a big round number a lot of people would watch. That's the kind of thing that would get me interested. If I see that on the chart of SPCE, I'll get interested in maybe think about that as a potential long position, because above 10 would mean you've now put in a higher low and you're putting in a new swing high. And that's enough of a follow through that tells you that it's not just a fluke, not just people buying on severe weakness just because. It's people buying into the longer term idea and more accumulation of shares. So that's what I would be looking for on a chart like this. I always talk about a sign of accumulation, signs that recognize that it's no longer going down and that buyers are not just buying for a short-term gain, but really starting to recognize the upside potential. If enough of that happens, the price will show you as it goes higher and higher. Great questions there, by the way, and thank you so much. Please keep them coming. We'll get to more Tuesday of next week. We need to wrap the show. Go to the 3 in 3 charts in 3 minutes today, brought to you by Tradier Brokerage. If you go to Stock Charts ACP in the lower right corner, you see the little arrow. That is the Tradier Brokerage symbol. You can actually trade directly from our Stock Charts ACP platform with Tradier. Chart 1 of the 3 in 3 is a ratio of consumer discretionary versus consumer staples. We've reviewed this often on the show. We didn't get to it in the wrap of the week segment earlier on this show, but we have talked about it before. In the top segment, you have the XLY over the XLP. On the bottom, you have the equal weighted version of those two ETFs and how they're moving. The top one is sort of skewed to the mega cap names like Tesla and Amazon, which take up a huge weight in the XLY. The bottom one's equal weighted to make it more of an even measurement of whether investors are on the offensive or defensive side of the consumer space. Since November, this has been going downwards. You see it a little bit of a bounce this week, over the last week or two. That's totally fair. But overall, I still see these ratios as trending lower. Even though the S&P went higher in December and made a new all-time high around 4,800 in January, I would argue the top, for all intents and purposes, was in November. That's when the breadth started to deteriorate. That's when the momentum peaked. That's when these ratios peaked, which tells you that the rotation was happening before the market topped out in December into January. These ratios keep going down. That tells you investors are remaining defensive. It tells you to avoid the risk-on scenario until further notice. Chart number 2 is Uber Technologies. This is a little shorter term chart than we tend to show, and this is intended to zoom in to one particular candle pattern. Do you know your candle patterns well enough to know what this pattern is? And I'm indicating on the chart. This is a nice uptrend bouncing off of new swing lows in late January. We moved higher. We test the 50-day moving average. We have an up day and then a down day, and the real body, the open to close range of day 2 engulfs the range of day 1, and that is your hint. That is a bearish engulfing pattern. That is a short-term sell signal, which shows you after a run higher, you open higher, but then you close below the previous day's range. And as a result, that tends to be a negative short-term signal. We followed through to the downside. It's a great reminder to pay attention to candle patterns, particularly if you're a swing trader, more short-term oriented. Finally, UA Under Armour. When I look back at this earnings season, what are my main takeaways as we're winding down? Overall, results have been fairly decent, I would say. Number 2, you're seeing companies report some good results and tending to beat estimates, which is good. But I think the chart of UA and the results from UA really tell the story. They talk in their earnings release about the challenges of supply chain issues and the ongoing issues that they're expecting through the course of this year. A company beating earnings and the stock price going down like this tells you farther out expectations are more negative, and that might be the thing, the story that pushes the markets downward. Folks, that is our show and a wrap for this week on the Final Bar. Thank you so much for joining us. You can see all of our previous episodes and interviews at our on-demand platform, stockchartstv.com. For stockcharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.